Making financial sales over the phone. We're talking life insurance, retirement planning, estate planning. Many sales agents have now turned exclusively to this, and it seems to be working for them. But should they continue based on the trends? To be honest, I'm a little on the fence with this one. And here's why. Let's start out by acknowledging how the financial sales environment has evolved quite a bit over the last few years. Just like nearly every other industry, it's gone digital and in some form faceless. Let's take a look at the changes in the distribution landscape for life insurance sales. Historically, it was going out, knocking on doors, passing out brochures. You would actually ask in person to set an appointment, for which another appointment where you would have to come back and sit down in the home. After all that, if you make the sale, you'd have to take their check, staple it to the application, and mail it in to the insurance company. Then you'd have to wait at least a couple of weeks just to get an update. And your application better be full and complete. There's just so many opportunities for something to go wrong. The application may be incomplete, the application may be declined, the insurance carrier may need additional information, the check may bounce, and the more time that lapses, the more likelihood one of these issues will occur. And in the really old days, you had the responsibility of picking up subsequent checks. I'm reminded of a policy that my mother had with AIG all the way back when I was in grade school. For the continuation of this policy, the agent would stop by our house once a year to pick up the premium check. There was no automation. I don't even think they set up appointments each year. I think he would just stop in, and if he caught us at home, he'd pick up the check and send it in. This went on for over 20 years. It was actually just last year that my mother received a notice in the mail from AIG stating that her policy of over 25 years had recently lapsed. Lapsed due to non-payment. Rather than call it AIG, she actually calls me about it. And I remember I asked her, I was like, well, when's the last time you've made a premium payment? She admitted she had not seen him for the last couple of years. He simply just had not stopped by her house. We called up AIG just to learn that he had died a few years back. I'm not trying to make a funny story out of this guy's death, but I find it a little humorous that his death resulted in our lapse. Long story short, we've got a great relationship with AIG. They were quite sympathetic in the situation. We were allowed to reinstate the policy as it was. But the point here is that this could never happen in today's automated environment. So back to the topic at hand, life insurance sales today is becoming less human interface and more digital interface. TeleSales, and I'm just throwing this out there, could very well be just the next current step of a total phase out of humans altogether. But personally, I don't believe this is wise or even possible. And I'm going to come back and explain this in just a moment. Are there pros to telesales? Well, yeah. I mean, number one, speed to market. And you have to credit this to COVID-19. But agents today can now complete the entire sales process without ever being in close proximity with a client. This includes the initial conversation, the appointment, the consultation, the underwriting, the payment process, and even the signatures, all completed digitally. And what else does telesales give us? Reach, faster paced policy writing, and the ability to reach across the nation. Everything just done right there on the phone. And to the agents who play the numbers game, this was totally breakthrough. Get rejected? No big deal. Move on to the next phone call. Didn't lose any time traveling. Didn't have to walk around neighborhoods knocking on doors. No answer? No big deal. Just make the next dial. Virtually no waste and faster turnaround to the next opportunity. I get it. However, if you know me, you know there's a but in here somewhere. I'm on the fence, remember? Although I'm all about efficiency and the maximization of production, I choose to consider the long-term perspective. What do I mean by this? Allow me to explain this again. If you're buying those cheap garbage leads I'm always ranting about, you're metaphorically scooping sand, hoping to sift out an opportunity. And at this moment, allow me to share one of the latest reports we received from someone buying leads from one of the lead centers. A sizable order of aged leads, 3 to 6 months old, more than 60% of the leads, either a disconnected line or phone number had been changed. But we're not going to travel that road today. That was the last video. I will put the link to it right here for you. Today, I want to get into why I believe that true advisors simply cannot be replaced by tech. We'll take advantage of the digital convenience, but we cannot be removed from the sales process completely. To choose proper life insurance, retirement plans, investment strategies, you're going to need to consult in someone who knows this stuff. The advantage we advisors have is people are just too lazy to educate themselves. The technology can be as user-friendly as you can make it, but if they don't know what to buy, they're not going to buy anything at all. Now, here's the most interesting part of this entire study. When you buy something in the digital environment, by definition, this falls under the category of e-commerce. So if I'm a financial advisor and I engage in telesales, I'm basically participating in e-commerce, which means I'd be wise if I was familiar with the statistics that come with this type of sales environment. And did you know that the recent studies in e-commerce have shown that at least 30 to 40% of sales sold by someone other than in-person and brick and mortar are returned? I feel like I've heard something similar to this elsewhere. And I'm not even talking long term. I'm specifically talking about the lapses within the first year of writing. We have received direct reports of up to nearly 40% of newly written business lapsing within the first 12 months. One can't help but wonder if there's a connection here. And there was another study that showed that e-commerce sales are 2 to 3 times more likely to be returned than brick and mortar sales. Well, I'm definitely curious to see if anyone else agrees that there might be a correlation here. Feel free to share in the comments. Also, feel free to like, share, and subscribe if you wish. We have more content like this one right here, and we're promoting our friend Patrick Bet David right here. See you guys next time.